Ever wondered how a small sum can turn into a fortune over time? It's not magic, it's compound interest. Let's embark on a journey to understand the phenomenon that Albert Einstein once called the eighth wonder of the world. Compound interest is not a complex concept, but its effects are indeed profound. So, what exactly is compound interest? It's the interest on a loan or deposit that's calculated based on both the initial principal and the accumulated interest from previous periods. Imagine you're planting a seed. This seed represents your initial investment or principal. As it sprouts and grows, it begins to bear fruit. Now, if you take these fruits and replant them, they too will grow into trees and bear more fruit. This is the essence of compound interest. You're not just earning interest on your initial seed or principal, but also on the fruits or interest that it bears. Now, let's compare this with simple interest. If compound interest is like a fruit-bearing tree, then simple interest is like a one-time harvest. You plant your seed, it grows, and you harvest. There's no reinvesting of the fruits and therefore no exponential growth. Consider this example. Let's say you invest £1,000 at an annual interest rate of 5%. With simple interest, after 20 years you'd have £1,500. But with compound interest, that same investment would grow to over £2,650. That's quite a difference, isn't it? The magic of compound interest lies in the power of exponential growth. It's not about getting rich quickly, but building wealth steadily over time. The more time your investment has to grow, the more powerful the compounding effect becomes. It's like a snowball rolling down a hill, gathering more and more snow as it goes along. Now that we understand the power of compound interest, where can we earn it? Stay tuned as we dive into the different avenues where you can harness the magic of compound interest. Traditional banks, our common money keepers, do they offer compound interest? Indeed they do. Banks are the most familiar places where we can earn compound interest. This interest is typically offered on savings accounts and fixed deposit accounts. The magic happens when the interest earned is added back to the principal amount, forming a larger base for calculating the next round of interest. This is the essence of compound interest. But how often does this compounding occur? Well, it varies. Some banks compound interest on a quarterly basis, others semi-annually, and some annually. The frequency of compounding can significantly affect the total interest earned. The more frequently interest is compounded, the faster your money grows. However, it's important to note that while banks are generally safe, they often offer low interest rates. So the question arises, banks are safe but often offer low interest rates. But are there other places to earn compound interest? Indeed, there are. Bonds, they sound complicated, but are they a good source of compound interest? Well, let's delve into that. Bonds are essentially loans that investors make to entities such as corporations or governments. These entities, in turn, promise to pay back the initial amount loaned, known as the principal, along with a fixed rate of interest over a specified period of time. Now, here's where compound interest comes into play. The interest earned on bonds is typically reinvested automatically. This means that not only does the initial investment grow, but the interest earned on that investment also generates its own interest. Picture it as a snowball rolling down a hill, gathering more and more snow as it goes. However, it's important to remember that the interest rate on bonds is fixed. This means that while they can be a reliable source of compound interest, the potential for growth is limited compared to more volatile investments. Bonds are a reliable source of compound interest, but let's explore more exciting options. How about the stock market? Can we earn compound interest there? The stock market, the land of bulls and bears, where fortunes are made and lost. Now, you're not going to earn compound interest in the traditional sense here, but there's a strategy that can yield similar results. Investing in dividend-paying stocks. When you purchase shares of a company that pays dividends, you receive a portion of the company's profits. If you choose to reinvest these dividends by buying more shares, then you're effectively earning compound interest as your dividends generate their own dividends. This can significantly accelerate the growth of your investment. However, the stock market isn't a one-way ticket to wealth. It's more volatile than a bank or bond investment, and your returns aren't guaranteed. Shares can plummet in value and dividends can be cut. Stocks offer potential for significant compound interest, but they come with their own set of risks. In the new digital world, can we earn compound interest from cryptocurrencies? That's a question many investors are asking today. Let's dive in and explore this intriguing concept. Cryptocurrency staking is a process that involves participating in a proof-of-stake (POS) blockchain network by holding and operating a node. In simpler terms, it's like being a mini bank within the cryptocurrency network. You lock up a certain amount of your cryptocurrency to validate transactions and support the network. This is where the magic of compound interest comes into play. When you stake your cryptocurrency, you receive rewards, usually in the form of additional tokens. These rewards are proportional to the amount of cryptocurrency you have staked. The more you stake, the higher your rewards. Now, these rewards can be automatically restaked, compounding your interest. This means that not only are you earning interest on your initial stake, but also on the rewards you've received. Over time, this can significantly increase your holdings, much like compound interest in a traditional savings account. However, as appetizing as it may sound, staking cryptocurrencies is not without risk. The cryptocurrency market is known for its high volatility. The value of your holdings can fluctuate wildly, which could either lead to high returns or significant losses. Moreover, staking requires a technical understanding of blockchain networks, and there's also the risk of network attacks. Therefore, it's crucial to carefully consider these factors before jumping in. But let's not forget the potential high returns. With traditional banks offering meager interest rates, staking in the cryptocurrency world can be a lucrative alternative, offering returns that can be several times higher. Cryptocurrency staking, therefore, presents an opportunity to earn compound interest in the digital world. It's like a high-risk, high-reward savings account on steroids. But like all adrenaline-pumping activities, it requires a safety harness of knowledge and careful thought. Cryptocurrencies offer a new way to earn compound interest, but like all investments, they require careful consideration. So, are you ready to take the leap into the thrilling world of cryptocurrency staking? So, we've explored several platforms for earning compound interest, each with its own benefits and risks. Let's do a quick recap. In the realm of traditional finance, banks offer a safe yet modest return. They're a reliable option, especially for those who prefer a more conservative approach. Bonds, on the other hand, present a slightly higher return, yet come with their own set of risks. They're ideal for those who can tolerate a bit of risk for a better return. Moving on to the stock market, dividends provide an opportunity for compound interest. With careful selection and diversification, one can expect a substantial return over time. Lastly, we dove into the world of cryptocurrencies, where staking offers promising returns, albeit with a higher risk profile. Remember, the key to compound interest is time. Start early, reinvest your earnings, and watch your wealth grow.